Welcome to the Kendall Report. Hello, I'm Bob Kendall. I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, click that bell, and share these videos. Yesterday's action in the market started off on a very strong note with the S&P up 93 handles. But by the close, all of that was given up, and the NASDAQ and the Dow Jones closed lower on the session. This reversal was quite significant, and it appeared to come after announcement that there's the ECB and other entities were going to put $6 trillion into the world economy. That's a joke, folks. We're talking about a $105 trillion world economy just in the Western world. There's no way that's going to do anything. It's just, all they're trying to do is window dressing to make people feel good. I've been talking to you in detail about the risk of the bond market. Well, there's some more details coming out today. There's a company called Mr. Cooper, which is the largest servicer of mortgages in the country. They announced that they got 86,000 applications for forbearance. It means 86,000 people aren't going to pay their mortgage payments. They are still on the hook for certain fees going forward, and they're going to have to cover that number. Mr. Cooper may not have enough liquidity to continue to pay these fees. So ultimately, the Fed and others may have to give them forbearance. So this is just piling debt on debt and forgiveness on forgiveness, and who knows where all this ends up. In 2008, that number got to 5%. We're talking 2 weeks, they're already at 2.5%. Folks are going to be watching this number very closely. If it gets up over 5, that's going to make a lot of folks in the bond and the mortgage market very nervous. I continue to tell you that there is a lot of risk in the bond market that has not went away. That, in fact, the equity markets are not at risk at the same level that the bond markets are at the moment. We saw treasuries gap higher in yield 2 days in a row, lower in price. And this is something I talked to you about over the last couple of weeks, to watch for treasuries start to move up. If they get above the 120 level, that's going to be the danger point. After that, you're going to see the collapse of the dollar. You're going to see rates skyrocket from there, probably to 160, maybe as high as 2% if this thing gets out of control. This will be when the bond vigilantes and others will show up, and there'll be a panic in the debt markets. So make no mistake, if that happens, the equity markets will also see some pretty good selling. There's going to be mass liquidation across the board. I've talked about over the past week and a half that I still expect to see some consolidation in the equity markets to move higher. We have moved up, and I'll go through this in detail shortly, into the range that I talked about. Those of you that own any of the mutual funds and ETFs with the MBSs, the mortgage-backed securities, some of these securities have actually traded up to all-time new highs. Others, if you look at them, they're about halfway back from where their low was. And this has to do a lot with what the Fed is buying. The Fed is buying a certain security in the MBS sector. The funds and the ETFs that are at all-time new highs, they've had the benefit of the Fed paying a premium for those bonds and those mortgages. Some of those funds are trading at a discount in spite of that. I suggest that if you own any of these funds or ETFs, that you sell out of them at an all-time new high and back off and restructure all your portfolios. I've been telling you for weeks on end, it's okay to be in cash, and it is okay. And this is the best place to be. We still have no idea what we're dealing with as far as the shutdown of the economy goes. I saw an interview with Larry Kudlow, spokesman for the White House, and he said these words, and it freaked me out when I saw it. He said, "We hope to get the economy back on in the next 4 to 8 weeks." I've talked to you on this channel over the last couple of weeks, and especially over the last several sessions, that any more than 10 days is going to be a disaster. If we go to April 30th, that will be a catastrophe. And there's not even a word if we go for 8 weeks with the economy being shut down. This is beyond comprehension. There's no idea the types of things that will break. I actually saw a video, I think it was on LinkedIn, some advisor actually saying these words, that this is what he's telling his client. It's like the economy right now is like a bear and he's hibernating, and he's going to wake up and be hungry, and everything's going to be fine. He's going to eat and everything's going to be wonderful. Well, the bottom line is it's not going to be wonderful. The economy is not a bear. But one of the things that I've talked to you about before is this dislocation of capital. So what's happening is income is almost at zero right now for major sectors of the economy. And what that means is that by putting trillions of dollars, the Fed buying securities and adding money and doing all the things they're doing, all it's doing is plugging that hole, but the income still isn't happening. So the gap just builds right back again. Until you get these companies running again, you get the economy flowing again, that hole just keeps reappearing. It's like literally a black hole. You put something in it, it disappears. It's going to keep doing that until the income of the economy comes back in. This is why I continue to suggest municipal bonds, any type of bonds, stay out of them. If your customers lose a couple months of income until this thing blows over, resetting them in the bond market is going to be a no big deal. But if they lose their principal, or they get locked into a bad bond or a default, then it gets really ugly really fast. You might remember back in 2008 those market rate securities they had that got absolutely blown up. You don't want to own this stuff in this kind of situation. There's just way too much risk in the bond market to actually take anything on. So continue to be in cash. It's okay. Be really careful with these markets and what you own. I've said this over the last couple sessions, and I'll say it again, is make sure you scrutinize anything you own on the books that looks or acts like a bond or a mortgage-backed security. These are very dangerous. Let's take a look at the technicals so we can see what the likelihood for the next several sessions is.
Let's start with the S&P 500 cash. You'll see yesterday's action where market peaked out and completely reversed and closed on the low of the session. These are never good signs, especially when you start to trade into some significant ranges. I've been talking to you about the objectives on the upside for a move toward the 2850 to 2920 levels. Let me explain where I got that number from. The length of this first wave, and this is being counted as an ABC pattern. This pattern I've discussed is going to be structured. This is the A wave up, the B wave down, and now we're working on the C wave. So there are a couple possibilities in this length of the C wave, this most recent move up, is that the first wave, this A wave, was 446 points long, and if we measure the C wave up, will be A and C will be equal. But there is another ratio to look at. Sometimes the C leg will be a shortened wave, and it will only be 61% of the length of A, which would be 275 points, suggest a move to 2722. Today we hit 2756. We exceeded that by just a touch. There was also some Fibonacci numbers I discussed in yesterday's broadcast, which suggested that the 2652 level was one of the targets for the upside. Now, this reversal on the downside is significant. Overnight, we've seen quite a bit of activity in the futures again. They've been up 1% and down about 0.6. They're currently fading down on the session right now. There's a 60% probability that this high that we saw yesterday at 2756 will be the high of this pattern, and then we'll start the second leg, and we should have a double zigzag, which will look like an ABCX ABC pattern. Then the market should go down. I still, as I mentioned in my opening comments, expect to see a consolidation, but it's going to be very choppy, and we still have huge volatility. We once again did 7.1 billion shares yesterday, and the VIX has come in quite a bit. It's still at 4670. Still a lot of risk in this market, but most likely we're just going to see volatility risk, and this is why I've continued to suggest for folks to stay in cash. You don't need to be involved. You don't need to get anxious. As I said in my opening comments, there is no magic silver bullet that's going to fix this thing. even though you're seeing all the central banks and everybody being very aggressive to patch the holes. If we look at the overnight futures, you'll see that it is continuing to see, it's taken out yesterday's low and following through a little bit. It's not down a lot, but the expectation is that we could go down to 25.68. We're currently 26.33 in the futures. So about 70 or 80 handles from here would be where the support is. Now the support is right at the 10-period moving average, which is up 0.66, which suggests that there's only a 20% probability for the S&P futures to go down below that level. It will be a different number on the cash, but very similar. Let's take a look at the cash to get that number. That number is 25.66. So they're very similar. They're only 2 points difference. But this pattern is likely to continue to unfold. And let me show you this ABCX ABC pattern that I'm discussing. This pattern will have the A, B, C, then there would be an X wave, which should come down into this 24 handle, could go as low as 23. And then there will be another A, B, C pattern. And ultimately, all of these are going to start, these moving averages are going to end up being crisscrossing. I know I've got a lot of lines there, but the moving averages will be crisscrossing, which is the inflection point of where we're going to be able to determine whether this was a bottom at the 2190 or whether there's going to be another sell-off that goes to the next level on the downside. There's no way to determine that right now. The weekly chart suggests the probabilities are for it to top out there and go to the next leg down. Quick review of the treasuries. I've talked about the gaps earlier in the opening comments. You'll see there's two gaps up. What's interesting is that the PPMs are turning up. The PPM2 is up 1.41. That's going to be a magnet. That's at 0.81. So we should move towards 0.81 to 0.9. Anything over 1%, 103 is right now the resistance. But if we get above 1%, there will be nothing until we get up to this, the 200-day moving average, which is 1.63%. There's nothing good going to come out of any of that if that happens. And this will be the sign that there's some serious issues going on with the bond market and most likely the mortgage market. Last market to look at tonight is gold. A lot of excitement over the last two sessions, trading all the way up into almost 1750. We saw a big reversal yesterday, and now we're seeing some pressure. And I talked about this, is that there was no way this was going to go much further, that the configuration of the PPMs suggests that this is going to come back in. Now 1640 is going to be support, and then again at the 1620 to 1600 level. This thing could completely reverse over the next several days. It will take a close above 1713 to trigger any higher prices here. The trends are still up on a short-term basis, but intermediate term trends as well as the longer-term trends, as I went through in yesterday's video. If you didn't see that, go back and watch that video. At the end of the video, you'll see I talk about those trends. Anyway, this will complete the show tonight. Thanks so much for watching. I'll talk to you tomorrow night.